Hi everybody, it's Bob Iaccino, co-portfolio manager of the Stock Think Tank. And it is Monday, January 18th. Markets are closed today. It is Martin Luther King Day. And first of all, I want to join everybody in celebrating that great American. But because markets are closed, I don't have a lot to talk about the direction of the markets for this week as of yet. So I brought a prop with me. And this is my last month's newsletter. And I want to read a small segment from it if I could, because some of the data that came out today, we anticipated in the newsletter. And Mike Arnold, my co-portfolio manager, and I don't talk about fundamentals as much as we do price action and our process, but we did talk about this. But online sales were in the midst of a huge surge well before the end of December. In my view, much of that holiday sales goodness was pulled forward. For instance, Target and Best Buy started Black Friday on Amazon Prime Day in mid-October. Remember, Amazon moved Prime Day this year. Instead of July 15th, Prime Day fell on October 13th and 14th. Once Amazon delayed their Prime Day, Target, Walmart, and then Best Buy started their Black Friday promotions around the same time. Now, mid-October is very early compared to past Black Fridays, which traditionally fell on the Friday after Thanksgiving Thursday, more than a month later. So I think a lot of that spending was pulled forward. Thus, I don't believe people are going to spend as much over this holiday season as they have in the past. They've already spent it, basically, especially when you consider that despite the early sales, the actual calendar Black Friday and subsequent Cyber Monday still broke records. Not in-store records, but online shopping records. The reason I bring that up is because last week we got the retail sales data, and it was terrible. It was horrendous. And it's not about a pat on the back. The title of this particular newsletter was Brace for an Ugly January for Stocks. And I would argue that we're actually getting that. So far this month, only two of the indices are up. The Russell is up dramatically. The NASDAQ is down. The S&P is basically up a couple basis points, and the Dow is basically flat. Retail sales came in at down 0.7%. It was expected to be unchanged, and last month was revised down to down 1.4. Ex autos, and this is month over month figures for both, down 1.4%. It was expected to be only down 0.1%, and that was versus a revised lower last month, down 1.3%. Those are terrible numbers. That comes off of the heels of the first negative jobless numbers since April, and the prior two numbers were also revised lower. So now we have a downtrend in jobless claims into a negative number with a negative retail sales figure. We also had Michigan consumer sentiment, which came out lower as well. So bad data, very bad data. Now, we did get talk of a stimulus package, $1.9 trillion. The talk prior to the speech by President-elect Joe Biden, who will be inaugurated this week, was of $2 trillion. $1,400 stimulus checks, and a raising of the minimum wage nationally to $15, which will hurt small businesses. And considering that we've already got 80,000 small businesses closed, that might not be very good timing. So I continue to say that the lower end of the economic stratosphere will spend those stimulus checks. But once you get to middle class, upper middle class, and wealthy, if they get the checks, and right now they don't really have a responsible way of sort of sifting through these people and making sure just those in need get the checks, the other people will save it. And it shows in this retail sales number that I just read off to you. And we predicted it in our newsletter. So you might look at our current portfolio and say, we're basically heavy on retail. Tomorrow morning, we'll be exiting Walmart on the open. If you didn't see the alert, make sure you take a look at it or go to the member portal and read the current alert. We're going to be selling Walmart on the open. That means we're going to get out of one of our retail stocks. And it's likely to be a small loss, not going to be a full loss by any stretch. But Best Buy is doing very well. Why? Because when people get a stimulus check and they do spend it, a lot of them go spend it at Best Buy. And then we've also got Big Lots, which just is a cash machine when the economy's in recession, which I believe we still are. And then we've got AbbVie and Aflac. Aflac is an insurance company or a reinsurer in a way, and they just have a solid track record. We're nearing the target on that one. And in our particular AbbVie stock, AbbVie is one of those pharmaceutical stocks that's been virtually ignored or neglected because everybody wanted to be in AstraZeneca and Pfizer and Moderna because they're part of the COVID vaccine push. That's going through, but AbbVie has a really solid business, and we're near our target on that one as well. So far in January, we've added somewhere in the range of 3 to 4% of positive alpha to our portfolio. So we're up about 3 to 4%, depending on where we get out of Walmart, and depending on what happens to these other stocks, we might be a little bit more than 4%. We might be a little bit lower than 4%. The S&P is essentially flat. So far, we're outperforming again. So I hope you guys are happy with that. In our special plays, we're in the dollar still in the form of UUP. We're approaching our target on that, and we've moved our stop tighter on that one. Now, one last thing I want to talk to you guys about. We are going to be much more aggressive in the near future of moving our stops up. So we might actually have some stop outs that maybe in the past wouldn't